Welcome to the Dealmaking with Laura DiFrancesco podcast. I'm Laura DiFrancesco, your host. We're talking all about mergers and acquisitions, buying and selling small businesses, as well as corporate law. We are taking our experience closing over $10 billion of transactions since founding Dean Street Law 5 years ago, and my experience being an M&A and corporate attorney for over a decade and making it accessible to you as an entrepreneur. I hope that this helps you in navigating the complex world of mergers and acquisitions. And also, we're always happy to be a resource for you here at Dean Street Law. You can always apply to work with us through our complimentary consultations linked in our show notes. And a huge shout out and thank you to everyone who's subscribed and left us a 5-star review. If you haven't yet, be sure to subscribe and also leave us a 5-star review. It's one of the best ways to support us as a small business. And also be sure to share with your friends and colleagues on social media, through text, email, or however is easiest. It means the world to us that you're supporting our content and helps us make more to support you in your journey. Welcome to the latest episode of the Dealmaking with Laura DiFrancesco podcast. We're here talking all about mergers and acquisitions, buying and selling real estate. So I'm excited to talk about today's topic, which is put options. And if you're new to mergers and acquisitions, put options may sound a little bit different. If you're in the finance world, welcome to mergers and acquisitions. I'm sure you feel comfortable here. So essentially, a put option is the right to sell. And you see this a lot in trading stock and public markets, but it's talked about less frequently in the private markets, specifically mergers and acquisitions. But it has become a more of a hot topic in entrepreneurship through acquisition and lower middle market mergers and acquisitions, because you see a lot of bigger players in private equity, hedge funds, etc., institutional investors coming down, investing in small businesses. And you see this become a more sophisticated topic also as you see different people from the M&A world also starting their own acquisitions or becoming more involved personally in mergers and acquisitions. So this is an interesting topic. It may seem from the get-go that it is more investor friendly, but actually it can be a very balanced approach to creating exit opportunities for both the investor and the operator. So with that said, we're going to dive into some more information here all about put options. I'm Laura DiFrancesco, founder of Dean Street Law. We primarily focus on lower middle market mergers and acquisitions and have closed over $10 billion of transactions as a whole since founding Dean Street Law. It is a wonderful experience that we've been doing for the last 5 years with Dean Street Law, and I've been in mergers and acquisitions attorney for over a decade. So lots of experience here, and we will break this down in easy to digest and understand takeaways so that when you're doing your own transaction, you have this background to have conversations and be able to make an informed decision for yourself. With that said, we at Dean Street Law are happy to work with you and support you in your transaction. Feel free to schedule a complimentary consultation through the link in our show notes. Let's dive in. Alrighty, so as I mentioned in the beginning, a put option is the right to sell an equity interest in a business. So when you are bringing on investors, when you're talking with people you want to start a business with, is there a party or do you personally want to have the right to sell your ownership? That's a put option. As simple as that is. And there's a lot of mechanics behind it. It can be at a fixed price, or it could be a formula that's determined based on the organizational documents. Typically, this is going to be something that you see in either your limited liability company agreement or your shareholders' rights agreements or something like that. Essentially, depending on what type of legal structure you have, the appropriate legal document to outline the rights of the ownership of the business. So whether that's shares being owned in a corporation or limited liability company interests being owned in a limited liability company. With that said, there's benefits both to the investor, providing liquidity and certainty, and also the operator. It provides funding, but also the ability to take over the business and get that business back under fully your control, or explore other funding options at another date in which you have different growth potential at that point, or historical record at that point. So there's a lot of pros and cons to both parties in a put option. And in the ETA space, we've seen this particularly become more relevant because we have what we consider typically upmarket players coming downstream, working in small business acquisitions, whether that be in the lower middle market, or otherwise. And where are these most common in these types of deals? They're going to be relevant when you have investors typically. Now, you can implement these rights when you have the founders together as well, but typically it's more an investor-driven conversation. I still think it's very important whenever you're starting a business and whenever you have ownership with another person that you do think about exit strategy. Now, a put option is a right to sell. There still can be a lot of other exit discussions that we talk about, drag along rights, tag along rights. Quickly, if you haven't heard about those, a drag along right is where you have the majority interest owner of the business has the right to force the minority interests to sell, whereas the tag along rights are those in favor of the minority interests, where the majority decides to sell, the minority has the right to join that sale at the same or better terms. And that's generally, and there's a lot that you can negotiate within that, but those are very high level explanations of a few different mechanisms for exits. But whenever I'm putting together a relationship between multiple parties where there's an ownership of a business, I'm always talking about exit planning in a lot of different scenarios. Death, incapacity, there's no ability to agree between the parties. How are we going to find a resolution for all of those things? And one of those is a put option. So it's an important conversation to have, whether it's you and an investor, you and a spouse, you and a founder. But you typically see these most prevalent in investor situations purely because that's something that an investor is going to be thinking about more specifically is their exit, because most investors are looking at some point to exit rather than founders that may be desiring for it to be an evergreen investment, meaning they invest and that's kind of their lifelong pursuit that they may sell at the end of their career, or they may desire to pass on to future generations. So exit planning is very important. Put options are just one option within the whole exit planning realm. Now, let's discuss the typical structure of put options and how you can start to have these conversations. They can be very simple, a paragraph, and they can be very complex with a lot of nuance to them. And it really just depends on your deal size and the sophistication of the parties and how different things impact it from a financial perspective for the most part between the parties. So there's a couple different elements that are going to be put together, whether it's a paragraph or several pages or more, when you're negotiating your put option, what that will look like. Number one is timeline. So there's going to be a trigger. Typically, there will be a trigger for this put option. It could be an outright option that can happen at any time, but most of the time there will be a timeline associated with a put option, meaning that the seller has the right to sell the equity interest, the ownership interest in the business after a certain period of time. This helps provide certainty for the operator or business in terms of how long they'll have access to that capital, how they need to replenish it, and what those cash outlays will be at what time potentially. So it's helpful for cash management. So sometimes a put option is from the get-go, I have the right to sell. Most of the time you'll see that there is some sort of time element where after 2 years, 3 years, 5 years, it's really dependent on what that conversation is and agreement is between the parties of how long will that capital be allocated to this investment, and when does the investor desire to have the right to exit. Now, there's also a lot that you can do within the overall terminology structure. It could be an obligation, or it can be a right and an option to exercise. So a put option or an exit obligation. they can be structured and worded differently so that there must be an exit at a certain time, or by a certain time, the seller has the right to exit, but they may not have to. And that is important because it's going to determine liquidity and overall structured negotiations between the parties of valuation. When it comes to navigating corporate law, entrepreneurship, and managing small businesses, experience matters. Dean Street Law is a boutique corporate firm specializing in mergers and acquisitions, and additional focus in real estate, commercial transactions, finance, and corporate governance. With over $10 billion in deals closed, Dean Street Law has extensive experience representing hundreds of clients in thousands of transactions, from small businesses to Fortune 500 companies. Whether you need startup guidance or advice on closing multi-million or multi-billion-dollar deals, we're your trusted partner every step of the way. Visit deanstreetlaw.com in the show notes to schedule a complimentary consultation. Speaking of valuation, the other key element to a put option is what will the value be and how must it be paid. So there's going to be payment terms and valuation. For a moment, let's just focus on valuation. Valuation, so let's say a investor invests $10 today. They may say, I want to have the right to exit in year 2 for $12 or $15 or $20. It depends on really the overall economics of the investment between the rights and influence that the investor has. So are they the biggest investor, or are they one of the smaller investors? So how much bargaining power do they have? And then there's a couple of different things that are going to impact it. Are they getting distributions? Do they have preferential rights? Are they getting a certain dividend or percentage or minimum growth expected return? There's so many different ways, terminology wise, that we can phrase and structure this. But in general concepts, what is essentially the couple of different elements that are going to essentially equate to their internal rate of return? That's what they're trying to figure out is, I want to get a certain rate of return from this investment. How is that going to be impacted by the amount that I'm investing, how long it will be invested, what payments I receive over time, and then also what is my exit value. So that's a whole financial modeling that you'll do with your financial advisors. And then we interpret those financial models and what everybody agrees upon as this exit valuation. Typically it's a formula. Sometimes it's a number. Most often it's a formula. If it's not a number or a formula, it may also be determined by a method, meaning that when the exit time occurs, the parties may engage a valuation expert to do a valuation at that time. So those are the 3 standard methodologies, or 3 standard ways, typical ways you would see a put option be structured, which is 1, having a fixed price, 2, having a formula, and 3, having a methodology. The methodology could be a few different things. So at, let's say, year 3, when the investor wants to exit and when you want the investor to exit, that's what you agree upon. You could have a few different ways to structure it with valuation experts being engaged. Either the business can get a valuation, and if it's within a certain range, then that's what it is, or if it's not contested, then that's what it is. Otherwise, or you could have the investor pay for that. Otherwise, what typically happens would be, if you don't want to do that route, you could have each party have their own valuators. This does get more expensive. And then if they're within a similar range of a certain percentage, then it's averaged. If it's not, then a third is going to be engaged. And each of those appraisers are going to decide on an independent third-party appraiser, and that third-party appraiser will either be the final say, or it will be an average of the 3. I mean, literally, contracts are as creative as you'd like them to be. The other option is from the get-go. You could have each party appoint a valuation expert, and then those parties appoint a valuation expert, and that what they say is gold. So essentially, you just have to think of a way that you want to have it be valued in the future that makes sense for the size of your deal and transaction so that it's not overgunned. And then also make sure that you have some dispute resolution provisions in there, because value is a very sensitive topic. It is highly likely to be disputed. So how can you resolve it if there is a dispute, or is that the final say? So those are a few different ways you're going to talk about valuation. And then the other component too is, how do you think about the payment terms? Is that payout going to be a lump sum, or may it be as a seller note or as a note that's paid over time? And is that payment over time a fixed amount or variable based on the performance of the business? So there really can be a lot of flexibility here and have a lot of pros and cons to both parties. And then a few of the key terms that you want to think about as you're talking about this with others is exercise rights. Those are the triggers for the seller to have the right to sell the equity interest. And then, of course, payment terms, like we talked about, is how that valuation is paid in a lump sum or over time, and how those are all going to be negotiated with your lawyer and, of course, Dean Street Law if you'd like to work with us. The structure of a put option benefits investors and operators alike. It does seem on the face as an investor-friendly provision, but when done fairly and when done well, it can actually be a wonderful provision that benefits both the investor and the operator. Thinking about buying a business? Unlock the secrets of successful acquisitions with Acquisition Insights, your legal roadmap for success. With over 81 modules of video lectures, written materials, guides, and checklists, we provide in-depth guidance to navigate every step of the process. From initial interest to closing the deal, get the expertise you need to make informed decisions. You can also access our battle-tested templates in the Acquisition Insights course and templates bundle, including our template LOIs, letters of intent, pre- and post-LOI due diligence request list, material deal terms lists, and more. Visit lauradifrancesco.co/the-shop today and take the first step towards buying your dream business. All the links are in the show notes. Let's talk about a few of the different things that an investor is thinking about when they're approaching a put option. So typically the driving reason why they want to secure a put option is an exit opportunity. Most of the time that's liquidity, but it can also be always good to have an exit option when you're doing business with someone, because let's face it, sometimes business relationships can be even more of a commitment sometimes than marital relationships. And then in addition to that, it gives them exit certainty. So that exit certainty is going to really allow them to plan financially. A lot of investors are looking for planning for their portfolio, planning for their capital allocation, so that exit certainty that they have that capital back, which is really central to a lot of funds, whether that be private equity or hedge funds or other institutional investors. There are a lot of language in most funds where you have to have a certain exit for that capital to be returned to the investors of the fund. So that's why, of course, you're seeing it come more into the ETA space. And then that'll help with portfolio planning, risk management as well, because a lot of investors are looking to allocate capital for a certain period of time, get the return on investment that they're looking for, exit, and then plan for downside. And of course, having an exit valuation is going to assist them in minimizing that downside risk. So it'll help in risk management and downside protection. That benefits an investor tremendously. But what are they giving up, and how can it benefit the operator? One of the biggest things they can be giving up that does directly benefit the operator is often the upside. They're looking for more certainty, so more risk, more reward. Less risk, less reward. And so when you're structuring all of these things as a whole, most of the time when you're having these put options, there can also be a cap, because that exit may be a cap on the amount of return that they get in the transaction. Doesn't necessarily mean that there has to be, but oftentimes that is what the handoff and trade-off is between the two. So with operator impacts, there are some downsides for sure. It does create more of a short-term solution for fundraising, and knowing that you have to plan capital and fundraising for capital accordingly. So that is one of the biggest impacts. It can also put a strain on cash and cash management if you don't include payment terms for that payment and it has to be paid as lump sum. That can definitely be challenging. So cash management and that it's funding short term. You want to make it long enough so that you're not fundraising immediately. Fundraising does take time, so I would be hesitant to make it under a year. 2 years is really a short period of time. 3 years is where you start to be more of a normal time frame. I would say 3 to 5 years, but it depends on the parties. And there can be a need for short-term funding, but just be careful of cash management and not putting yourself in a situation where you fundraised for a year and then you have to fundraise again for another year. It can be exhausting always fundraising. And so you want to be cognizant of that as you're planning. But the greatest benefit is it gives you the opportunity to buy back ownership in the business, whether that's for you or whether you determine that that's allocated to other investors or whatever the case may be. But it gives you the opportunity to get back more control, more rights to the distribution overall, and clean up the cat table a little bit and simplify things and bring things in-house. So that can be very, very persuasive. And then for the most part, once you buy someone out, then you get the benefit of the upside beyond that. So that also really helps to provide some positive scenario planning for an operator. Overall, this is something that can be very beneficial, very fair for both parties. It's something that you do have to have a lawyer to help you negotiate because it can be complex and there's a lot to think about when thinking about exit planning. Dean Street Law is happy to help you. We would love to support you in your transaction. You can feel free to reach out to us through the complimentary consultation in our show notes. And please be sure to share this with colleagues and anyone who it might benefit. Share us. Tag us on social media at LM DiFrancesco on X, at Laura DiFrancesco on Search Funder, at Dean Street Law on Instagram and other platforms. You can subscribe and be sure to leave us a 5-star review. That's one of the greatest compliments you can give us as a small business and encourage us to keep creating more content that supports you and your adventures in mergers and acquisitions. If there's a topic that you'd like to cover, I would absolutely love to hear it. Be sure to comment in one of our latest posts so that we can add that to the roster. We love to create topics that are helpful for our community. This was actually a topic from a post on Search Funder that I responded to, and it's hard to write in a couple of sentences what our thoughts are on some bigger topics because there's so many complexities to these things and a lot of consideration that we want to put into it to be able to give actually good advice. So be sure to connect with us on social media and I will see you in the next episode. Thanks for tuning in. Happy deal making. Thank you so much for joining us on this episode of the Dealmaking with Laura DiFrancesco podcast. I hope you found today's discussion insightful and that it brought you one step closer to mastering the art of mergers and acquisitions. If you enjoyed this episode, please be sure to follow and subscribe to Dealmaking with Laura DiFrancesco on your favorite podcast platform so you never miss an episode. And if you found value in our discussion, please leave a 5-star review. It would mean the world to us. And share this podcast with your network, friends, and colleagues. For more in-depth resources, be sure to visit our website, deanstreetlaw.com, where you can find articles, guides, and more information on our services. Don't forget to follow us on social media for the latest episodes, updates, tips, and exclusive content. You can find us on LinkedIn, Search Funder, at LM DiFrancesco on X, and at Dean Street Law on Instagram. Join us on our next episode where we'll explore more deal-making insights. Cheers and happy deal-making.